I spent $650,000 and 2 years of absolute physical and mental hell operating an independent gas station and convenience store in suburban New York, all so you do not have to ruin your financial life. Before you fall for the American dream of owning a high cash flow gas station, let me give you the raw, brutal numbers that business brokers and social media gurus conveniently hide. In New York, you are not running a fuel empire. You are operating a high-liability credit card processing center that happens to sell potato chips on the side. When you account for a mandatory NNN lease, skyrocketing New York property taxes, an 11.5% SBA loan rate, and credit card swipe fees that devour your gross margins, you are not building passive wealth. You are paying $650,000 for the privilege of becoming an unpaid slave to your landlord, your fuel jobber, and the Small Business Administration. If you think selling gas at $3.89 a gallon means printing money, this autopsy is for you. Here is the true story of how a $650,000 investment almost cost me my home, my sanity, and every single dollar I had ever saved. Reflectively, like millions of mid-career professionals in America, I was completely burned out by corporate life. After 10 years sitting in a windowless cubicle as a mid-level project manager, I had an overwhelming desire for autonomy. I wanted a real brick-and-mortar asset with predictable daily demand. After all, people always need gas. Rain, shine, inflation, or recession, drivers have to fill their tanks. When I found a listing for an unbranded gas station and convenience store on a busy commuter corridor in upstate New York, it looked like the ultimate ticket to freedom. The seller summary claimed a steady annual volume of 800,000 gallons and over $1 million in convenience store sales. It seemed indestructible. But I was about to learn the single most important lesson in business acquisition. Seller financial statements are pure fiction, and the capital required to get through the door is structured to trap you from day one. Let us break down the actual initial capital expenditure required to buy and take over operations of a turnkey leasehold gas station in New York State. Seriously, acquisition, goodwill, and key money came out to $400,000. Understated, this was the cost just to acquire the business operations, existing fixtures, pumps, POS controllers, and credit card terminals, and goodwill from the outgoing operator. Natural tone. Initial fuel inventory load costs $40,000. Assertively, you do not receive fuel on consignment. You must pay your distributor up front for the first 10,000 to 12,000 gallons of regular, mid-grade, and premium gas sitting in underground storage tanks. Seriously. Initial convenience store inventory took another $60,000 to stock the shelves with cigarettes, beverages, snacks, automotive supplies, and beer, verified by a third-party audit team. Conversational tone. Environmental and tank testing deposits, licensing, and state permits required $20,000. Corporate presentation tone. This covers New York State Department of Environmental Conservation under Title VI NYCCR Part 613, local municipal fire permits, Department of Agriculture and Markets scale certifications under Agriculture and Markets Law Article 16, and New York State liquor and tobacco licenses. Natural tone. Upgrading the POS system, pump controllers, and credit card terminals cost $22,000 to meet EMV chip card requirements at the pump and maintain PCI DSS compliance standards. Finally, the lender mandated a working capital reserve of $58,000 as a cash cushion for immediate cash flow lags. Dramatic reveal. That brought the total initial capital requirement to exactly $600,000. Sigh. I funded this $600,000 burden by completely draining my life savings of $200,000, which was every cent I had accumulated over 10 years in corporate management. Worried. For the remaining $400,000, I secured an SBA 7A loan. Skeptical. On paper, an SBA loan sounds ideal. Corporate presentation tone. The federal government guarantees up to 85% of the loan for amounts up to $150,000 and 75% for loans greater than that, allowing buyers to secure financing with 10 to 20% down. Ominous tone. But what bank loan officers never emphasize in their sales pitch is the personal guarantee requirement under SBA 5010. Whispers intensely. When you execute an SBA loan agreement as an individual owning 20% or more of the enterprise, you pledge all available personal assets as collateral. Tense. Because I was borrowing $400,000, the bank placed a secondary lien directly on my primary residence in New York. Visibly shaken. If the business defaulted, the bank possessed the legal right to foreclose on my home, seize my personal bank accounts, and destroy my credit profile for decades. Anger building. To make matters worse, SBA 7A loans feature variable interest rates pegged to the Wall Street Journal prime rate plus an allowed lender margin of up to 2.75% for loans over $50,000 with maturities under 7 years, or up to 3% for longer terms. Frustrated, as the Federal Reserve aggressively increased the federal funds rate from near zero to 5.25% to fight inflation, my variable SBA loan rate surged to 11.5%. Overnight, my monthly debt service skyrocketed to $6,350 per month in principal and interest alone.
The first 2 weeks felt exhilarating. Friends and family dropped by, local commuters pulled up to the pumps, and the register rang continuously. But by month 2, the honeymoon phase vanished, and the brutal mathematical reality of operating a small retail business in New York set in. Most consumers look at a gas station price sign displaying $3.89 a gallon and assume the owner is making a fortune. They believe that if crude oil prices drop, the operator keeps the spread. The reality is that retail gasoline is a zero-loyalty commodity with virtually non-existent margins, used primarily as a loss leader to drive foot traffic into the store. Let us dissect the exact anatomy of a gallon of gas sold at my station. Out of that $3.89 retail price, 18.4 cents goes directly to the federal gas tax under Internal Revenue Code Section 4081. New York State takes its share through a combination of taxes: the New York State Motor Fuel Excise Tax at 8 cents per gallon, the New York State Petroleum Business Tax at 17.3 cents per gallon, and state plus local sales taxes, totaling 28.1 cents per gallon in state taxes alone. The wholesale cost, known as the rack price, plus freight delivery cost me $3.29.5. That left a raw gross margin of roughly 13 cents per gallon. That might sound acceptable if you sell 60,000 gallons a month, which yields $7,800 in gross profit. However, that figure ignores the ultimate silent killer in retail fuel: credit card swipe fees. Over 85% of modern drivers pay at the pump using credit cards. Card processors do not calculate fees based on your net margin. They charge a percentage on the total gross transaction amount, including all federal and state taxes you collect on behalf of the government. When a customer buys 15 gallons at $3.89 a gallon, the total charge is $58.35. At an average merchant processing fee of 3% across Visa, MasterCard, and American Express interchange rates, plus processor markups, the swipe fee on that single fill-up comes out to $1.75. My total gross margin on those 15 gallons was $1.95. After paying the $1.75 processing fee, my total net earnings on a $58 transaction was 20 cents. That equates to a net fuel margin of 1.4 cents per gallon. If a customer paid with a premium rewards card or American Express, I lost money on the sale. Resigned, with fuel margins stripped down to pennies, I had to rely completely on the convenience store to cover operational overhead. Frustrated, monthly operating expenditures in New York represent a relentless machine designed to crush independent operators. Firmly, consider the monthly fixed cost structure I was forced to maintain. My base rent on a triple net lease was $12,500 a month. In a commercial NNN lease, you do not simply pay rent. You're contractually responsible for 100% of property taxes, building insurance, and structural maintenance. New York property taxes alone added $3,200 per month. Insurance covering environmental liability and premises liability added another $1,800. Common area maintenance tacked on $800. My effective monthly rent was not $12,500, it was $18,300 every single month. Then came labor and payroll taxes. The New York statewide minimum wage climbed to $16 per hour, while in New York City, Long Island, and Westchester, it reached $16 per hour with scheduled increases. Maintaining an 18-hour daily operation required 3 full-time equivalent shifts. Basic W-2 payroll averaged $11,500 a month. When you add mandatory New York State unemployment insurance under New York Labor Law Article 18, employer FICA taxes at 7.65% under IRC Section 3111, and workers' compensation insurance required under New York Workers' Compensation Law Section 50, payroll expenses consumed $12,900 every month. Operating walk-in beverage coolers, commercial ice machines, exterior LED canopy lighting, and HVAC systems 18 hours a day resulted in a monthly electric bill with Con Edison or National Grid averaging $3,800. Angrily, merchant credit card fees across gas and store items averaged $7,200. Bittersweetly, my SBA loan debt service was $6,350. Software subscriptions, POS maintenance, accounting services, and waste management added another $1,200. Adding these expenses together, my monthly fixed overhead reached a staggering $49,750. To reach a break-even point on $49,750 of overhead, with convenience store gross margins averaging 30%, I needed to generate $165,000 in store sales while maintaining 60,000 gallons in monthly fuel volume. By month 6, customer traffic slowed down. Anxiously, a massive corporate chain station opened 2 miles down the highway, selling fuel near wholesale rack price. Disappointedly, my fuel volume collapsed from 60,000 gallons to 38,000 gallons per month. Depressed, my store sales stalled at $85,000. I was losing $11,800 in negative cash flow every single month. My working capital reserve was completely wiped out, and I was staring directly at personal bankruptcy.
When facing the loss of your home and total financial ruin, you do not simply give up. You fight with everything you have. I went into emergency turnaround mode. Over the next 12 months, I attempted every operational adjustment, cost-cutting measure, and revenue pivot available in the retail industry. Here is step-by-step how I fought to save the business and why structural economic reality defeated every attempt. The largest variable expense on my profit and loss statement that I could directly control was labor. I did what thousands of struggling independent operators do. I laid off 2 of my 3 full-time employees and took over their shifts myself. I opened the store at 5 in the morning and closed it at 11 at night, 7 days a week, working 112 hours a week. I served as store manager, cashier, janitor, inventory clerk, and pump technician. I slept on a folding cot in the back storage room between delivery trucks. By taking on these duties, I reduced monthly payroll expenses by $7,500. However, the physical and mental toll was severe. Severe sleep deprivation and physical exhaustion broke my health down rapidly. Furthermore, operating completely solo meant I could not properly maintain the forecourts, clean the store, or manage inventory controls. Inventory shrinkage rose by 2.5% because a single staff member cannot monitor 4 store aisles while operating the cash register. The $7,500 saved in labor was offset by $3,000 in stolen or unrecorded inventory losses and declining service quality, leaving a net benefit of only $2,300 a month at the cost of my health and personal life. To address credit card processing fees, I implemented a dual pricing cash discount program, compliant with Dodd-Frank Wall Street and Reform and Consumer Protection Act Section 1075 and New York General Business Law Section 518, which permits cash discounts provided display rules are met. I raised the credit card price at the pump by 15 cents per gallon while maintaining a discount for cash. Simultaneously, I restructured store inventory. Cigarettes and tobacco carry low profit margins, often under 8 to 10% in New York due to strict minimum pricing laws under New York Tax Law Article 20A. I downsized the tobacco fixtures and invested $8,000 on credit to install a fresh brewed gourmet coffee station, a hot food warming display for breakfast sandwiches, a New York State lottery terminal under New York Tax Law Article 34, and high-margin vape products. Coffee and prepared foods yielded 65 to 70% gross margins, while specialty vape items offered 55% margins. Cash discounting reduced my monthly credit card processing fees by $2,800. Hopeful, the food and beverage additions increased store gross margins from 30% to 36% on those specific product categories. However, suburban commuters strongly dislike the dual pricing system. In an increasingly cashless economy, drivers rarely carried $50 in cash to fill up. Customers pulled up to the pump, saw the 15-cent credit surcharge on the display, canceled the transaction, and drove down the road to the corporate chain competitor that absorbed credit fees through high volume. My total fuel sales dropped another 18%.
worried that loss in pump traffic directly reduced store foot traffic. Wistfully, the gourmet coffee sat unused, and unsold hot breakfast sandwiches had to be thrown away at the end of every shift as food waste. Determined that minor operational fixes were insufficient, I sought structural debt relief. I hired a commercial real estate attorney to negotiate a temporary rent reduction with my landlord, presenting audited financial statements showing that the current NNN rent structure was forcing the business into insolvency. At the same time, I requested a hardship deferral from my SBA lender to transition to interest-only payments for 6 months. The landlord's response was firm and legally uncompromising. They refused to reduce the base rent by a single dollar. Because my 10-year lease agreement was secured with personal guarantees, the landlord knew that if I defaulted, they could sue me personally and pursue my home equity. They had no financial incentive to lower the rent because the legal system guaranteed recovery against my personal assets. Relieved, the SBA lender did grant a 6-month interest-only payment modification. This reduced my monthly debt service from $6,350 to $3,800, providing temporary cash relief of $2,550 per month. However, this was only temporary relief. Unpaid principal was added to the end of the loan term, and interest continued to compound at 11.5% under my variable rate agreement. Frustrated, I was paying thousands of dollars a month merely to keep the loan out of default without reducing the principal balance by a single dollar. Reflective, why did these aggressive turnaround strategies fail to save the business? It comes down to a structural reality in corporate finance known as fixed cost rigidity. When your fixed costs, including NNN rent, property taxes, minimum debt service, and utility baselines, exceed $40,000 per month, the business becomes highly fragile. Variable cost adjustments like reducing headcount, changing suppliers, or offering cash discounts only impact your financials on the margins by a few $1,000s. To overcome a massive fixed cost burden, you require high revenue volume. Yet, an independent single-site gas station cannot expand its customer base beyond its physical geographic location, local traffic patterns, and strong corporate competitors with far superior wholesale purchasing power. I was trying to hold back a flood with a piece of tape. By month 18, I entered the most difficult phase of business ownership, a situation where the business is a severe financial burden, but you cannot afford to close it, nor can you afford to keep it running. Why not simply lock the doors, turn off the lights, and walk away? Because in American commercial real estate and small business finance, walking away triggers total personal asset recovery. If I surrendered the keys, I would be in default of a 10-year commercial lease with 8 years remaining. Under New York law, while a landlord has a duty to mitigate damages under Real Property Law Section 227E, they can sue for unpaid rent balances, which in my case represented over $1.1 million in total lease liabilities. They would immediately place a lien on my home. If I defaulted on the SBA loan, the bank would initiate foreclosure proceedings on my house within 90 to 120 days under standard SBA liquidation protocols. I was trapped in an economic vice. I was losing $5,000 to $8,000 a month keeping the doors open, but closing meant immediate personal bankruptcy and losing my home. I paid thousands of dollars every month simply to buy time, searching for a buyer to take over the leasehold. When you analyze the independent gas station and convenience store model in high-cost states like New York, the structure of the system becomes clear. The small business owner assumes 100% of the operational, physical, and financial risk, while surrounding entities extract guaranteed returns. The landlord collects guaranteed NNN rent backed by your personal home equity through personal guarantees. Federal and state governments collect over 46 cents per gallon in guaranteed taxes before you earn anything, alongside local property and sales taxes. Credit card processors and financial institutions collect a fee of roughly 3% on every dollar flowing through your pumps, taking zero responsibility for environmental leaks, labor expenses, or maintenance. The SBA lender earns an 11.5% interest rate backed by a federal guarantee and your real estate. The fuel jobber collects their wholesale margin on every rack delivery, protected by cash deposits or letters of credit. At the bottom of this financial structure sits the independent store operator, working over 100 hours a week, exposed to fuel vapor liabilities, managing security risks, and watching their life savings disappear. After 22 months, I found an exit. I transferred the business rights, store fixtures, and remaining inventory to another operator for $180,000, resulting in a $420,000 loss on my initial $600,000 capital expenditure. The $180,000 from the sale went directly toward paying down a portion of the SBA principal and clearing vendor liabilities. I walked away with zero cash reserves, my $200,000 life savings wiped out, and the remaining $220,000 SBA debt balance that I had to structure into a long-term workout agreement under SBA debt forgiveness guidelines. I lost 2 years of my life, my financial security, and my physical health. But I saved my home. If you are considering buying a gas station, a convenience store, or any small retail franchise in a high-tax, highly regulated environment, remember this fundamental rule of commercial finance. Revenue is vanity, profit is sanity, but cash flow and fixed cost flexibility are absolute survival. Before signing a commercial lease or executing an SBA personal guarantee, answer 3 critical questions. First, what is your true fixed cost burden? If your fixed rent, debt service, and operating overhead exceed 40% of realistic gross profit projections, you are taking a severe financial risk rather than operating a business. Second, what is your defensive moats against payment processing fees and corporate competition? If your revenue depends on selling price-sensitive commodities with net margins under 10%, standard swipe fees will destroy your operating cash flow. Third, are you prepared to pledge your primary home as collateral for a business model controlled by external economic factors? The dream of business ownership is real, but it requires strict financial reality. Do not let broker listings, adjusted sellers' earnings statements, or visions of passive income obscure the numbers on a profit and loss statement. Protect your capital, analyze the fixed costs, and evaluate every line item before you sign.